Yeah, let's take a look at round 3 here and see what happened. Oh, I haven't even done the worksheet yet, so I'll maybe do that while I'm um, talking about the round a little bit. So I'm gonna open that up and take a look at there's round 2, but we'll get ready for round 3. So first, let's go back and take a look at the round 2 assignment and look at the answers there. Folks really seemed to have a problem glancing through, and I haven't corrected or assigned grades yet, but I've read through everybody that submitted. There was a dearth of submissions based on the number of people in the class, and granted, Team Chester would not have been required to submit last round, but there should have been far more people submitting assignments than what I received, so shame on you. And of course, any assignments received after I've done this, I don't know if I can, well, I can't grade them because I'm giving you the answers. So yeah, late assignments I just can't accept here, and I need to go over these assignments to show you the types of things. So here we go. Since the start of the game, every student-run team has sold stock or shares. What is the effect on this transaction on earnings per share? I'm sorry, hang on here. There. If you unplug your phone, it quits ringing. So, what's the effect on earnings per share? Well, it reduces earnings per share. Okay, because earnings per share is simply equal to the earnings divided by the number of shares outstanding. Well, when we increase the number of shares outstanding, the denominator, right, the result is a smaller number. Okay, I mean, just real simply, let's break it down. Let's say we had 100. I'm going to make this bigger. We have 100 shares outstanding, right? Okay, and let's say we made $100. It's hard to draw with a mouse, right? Then my earnings per share is 100 divided by 100, or equal to $1 per share then, right? There's a decimal there. Okay, but what happens then if this becomes 200 shares? If I sell another 100 shares, what happens? Well, then I have 200 shares outstanding, and let's say it doesn't really have an effect on profitability, and really selling shares wouldn't necessarily have an effect on profitability. Okay, then I would still earn 100, but I'm dividing it by 200, and so now all of a sudden my earnings per share are only 50 cents. Okay, so yeah, I'm hoping that a little smaller illustration of this, or using less shares and whatnot, maybe illustrates that a little bit better. Granted, when you have 2 million shares and you sell 50,000 shares, the impact may be small. Okay, now companies issue shares all the time, but companies also buy back shares. In fact, there's been far more buybacks lately than there have been issuances of shares. So is issuing shares, if it reduces your earnings per share, a bad thing? Well, not necessarily, because you may have places to invest that money that may give you a better return. Okay, if it's invested properly. So selling the stock and raising some money might increase this. Okay, now that said, when I look at our game, okay, when I look at round 2, okay, nobody's selling the stock to make huge investments in certain areas, right? Okay, or at least areas that are extremely important. They haven't, right? We haven't made huge investments, say, in automation, or huge investments in capacity, or huge investments here or there that really require the sale of stock. Okay, and especially if they perhaps could have been financed otherwise through the issuance of bonds or something like that. Okay, so it's important to realize, I guess, what the effect is. And again, I'm not going to say that the effect is bad necessarily. Okay, Ferris issued some stock this last round, which kind of surprised me a little bit, round 3, and that surprised me a little bit. But perhaps we'll see why when we take a look. Okay, at round 3. Okay, then the next question was, so what happens to ROE? Well, it reduces ROE for much the same reason. Okay, so if we sell stock again, okay, we got 100 shares outstanding, okay, and maybe we get $10 per share, right? So we have, you know, $1,000 of equity then, okay, and we earned $100, remember? Okay, so our return on equity in that case was 10%, 0.10, right? Okay, or 10%. Now, if we sold another 100 shares, our equity is going to go up for the same 10 bucks if we got that. Okay, our equity goes up to 2,000. Oh, my drawing's horrible, sorry. And our earnings stay the same. Okay, you know, assuming it doesn't have any impact. And all of a sudden then our ROE goes down to 0.05 or 5%. Okay, again, I apologize for my drawing. Okay, but it clearly demonstrates then, when we use maybe a little smaller numbers, what impact it has on ROE, okay, and earnings per share. You might note too, when you look at my score sheet, what 2 things I score most highly. Okay. Question 2, Team Andrews and Team Chester had similar total sales. If you were to look just at the selected financial statistics in the Capstone Courier, what things might tell you why Chester had a much higher profit? Really struggled. I read through the answers, and I think maybe one person got this one correct, and it was meant to be not that difficult, I didn't think, but obviously we have to talk about it. Simply put, higher contribution margin, lower SG&A to sales. Okay, and let's go have a look at what I mean. So when we're looking at this, Chester, Andrews, right, really close in sales, 900,000 difference. But look down here, 33.5% contribution margin, 27.8. So there's roughly a 6%, you know, forgive me for rounding off, but roughly a 6% difference there. 6% of 130, you know, let's round those off, is what, 8 million, roughly 8 million. Okay, and then you know, 0.7, so a little less than 1% there, you know, so that'd be another 1 million. So it's 9 million in total difference, right, between the 2 teams, which explains, you know, here's 8 million in total earnings before interest and taxes. So there's a couple other things that are in there, but that's the biggest thing, is the difference between the contribution margin and the SG&A to sales. Now, what happened is I got lots of responses that said things like, oh, Chester's ROS is way higher. Well, ROS is a result of income, okay? Because they had a higher income, they had a higher return on sales, because return on anything is net income divided by whatever that anything is. So it's our net income divided by our sales, okay? That doesn't lead to a higher profit, it's a result of a higher profit. Same with ROA, 9% to 2.5%. Same thing. That is a result of our higher profit, okay? But on the other hand, contribution margin, having a higher margin for our goods, we're getting more profit out of each item that we sell, okay, leads to the higher profit. Okay, so we're in many cases, the answers that I read anyhow, were kind of getting the cart in front of the horse, or something backwards like that, right? And it's saying that we're looking at the results of the net income versus what actually causes the net income. These two are directly related. Now, as I said before, you got to remember you want a higher contribution margin and perhaps a lower SG&A to sales, but we have to be careful. We have to be careful because you use this SG&A to sales to also drive sales. Okay, so it's an efficient look, or an efficient and effective look, and that's what we can say. They had similar sales, right? But Chester had a little lower SG&A to sales, meaning that they were a little bit more efficient or effective. So they spent a little less money. I know that because their sales are about the same. They spent just a little bit less money than Team Andrews, but actually were able to generate a little more sales. Okay, so they were a little more efficient or effective with that. It doesn't mean necessarily that their marketing and sales budget was more effective, but they were more effective than perhaps with some of the other things they did, positioning, okay, age, those types of things, price, perhaps, things like that, right? Okay, so that's, then we get the last question, sorry, question 3. And I think most people did pretty well on this, but Andrews had 1,430 units available for sale in the performance segment. What percent of the market would that have been had all the units been sold? Simply, 1,430 is what they had available. The full demand for that segment was 2687, so the answer would be 53.22, around 53 or 54% would be the answer. That's huge, unless you're positioned and or your competitors are positioned to allow that to happen. And we'll take a look in round 3 that is happening in a couple of the segments. Okay, not for Team Andrews, but for one other team. And so, my point here again is really, really pay attention. Okay, when you're making your decisions and when you're looking at the Capstone Courier and when you're doing all those things, really, really pay attention. Okay, are you really positioned? Team Andrews, were you really positioned to sell 53% of the market, okay, in the performance segment? And the answer obviously was no. Okay, and so, look at those things when you're making those decisions. What can you really drive your sales to that level? Doesn't matter if it's 53%; it might even be 10%. Right? Can you drive 10% of drive your sales to 10% of the market in every case? So, okay, so let's go take a look. I need to still populate my worksheet, so I'm going to see if I can do that here maybe while I'm still talking. This is one, and I don't know if you guys get this same sheet or not, but have access to it from the dashboard called Selected Statistics. A lot of this appears on the Courier. Okay, and so it's not a huge deal that you guys would need to look at it because you're going to get most of it on the Courier. There's just a couple things that show up on it that I need for my worksheet, and so I try to look at it and put it in place, and hopefully it works. Sometimes copying this over, it must be because it's a decent amount of data, it takes a little bit of time, so hopefully it's going to work. We'll see here. Nope, it didn't. And so sometimes I got to do it a couple times. And yeah, and I guess I could pause maybe, but let's see if she's going to work this time. And we'll go. So round three was interesting. Okay, round 3 I thought was very interesting because we're definitely seeing, and I think I said that at the beginning, that we are definitely seeing some things show up. I think we can now make pretty good judgments about where teams are positioning themselves. Some teams in particular, other teams maybe a little less so. But there's some things that are surely just jumping out. Okay, there it kind of clicked, and so that's a good deal. Now I can go back and we can go to the Capstone Courier for for round 3. Getting that teacher mode, and then everything's chapters and all that. So we're looking at this, and again, my first look is probably at the sales number. And I look at this and I say, okay, wow, Chester had 170 million in sales. That's pretty good. Ferris had 235. Third place was Baldwin with 144. So quite a large discrepancy between those teams, right? A decent discrepancy between the teams. And then you jump down and you look a little lower and you start looking at the second thing, because I'm looking at the things that cause profit, not the things that are a result of profit. Okay, and so after sales is one of the first drivers of profit. Of course, you got to have sales before anything else. And then I look at contribution margin, and I go, wow, Andrew's got theirs up to 34.5. That's pretty impressive. 34.4 for Baldwin with quite a bit more sales, 40 million in sales, so that's even more impressive. Ooh, Chester had pretty good contribution margin, and now all of a sudden it's pretty low. Ooh, interesting. That might be one of your questions on the assignment for the week. And Erie and Ferris's contribution margin also, I think, dropped down from last round. So that's kind of interesting. I got to copy and paste one more bit of data here, so we'll do that. Okay, plug this into my little spreadsheet here, and there we go. Those little ones plug in easily, so I don't worry about those. It's getting that big one done. So again, let's come back up to the top and let's take a look. So we had sales of 235, 236, roughly for Ferris. 170 for Chester, 144 for Baldwin, but profits, oh my goodness, 14 million, that's pretty good. 5. Ooh, Erie just about matched Chester for profits. That's pretty impressive. Okay, and even though they had 70 million less in sales, so that's pretty impressive. But look at Baldwin, my goodness, 90 million less in sales. It looks like 91 million, or close to 92 million less in sales, if I'm doing my math correctly, and yet more profit by a million. What's that? $1,700,000? Wow, that's impressive. Okay, that's impressive. That leads me to think that Baldwin's doing some things right. Okay, if we went to the last assignment, what is it? Well, contribution margin 7% higher. 7% on 100, and use Baldwin sales. 7% on 140 million is 10 million extra, and about a full percent less here, right? So plus a full percent, which is another 1.4 million. So there's $11 million difference in profit, basically, because of the extra contribution margin. Hard to make that comparison because the sales are so much different. So I'm not saying that that's a good number that you should hang your hat on, but I'm just saying that had Ferris had similar sales, that's how much more profit Baldwin would have made. Okay, and that's how they're able to. That's the main reason they're able to catch up to Ferris. Okay, there could be other reasons too, and you want to look at those. But boy, that's huge. That might have partly answered part of your question. So we come down here and we do see the Ferris issued a little bit of stock, and I'd have to go back and look at last round, but I think that Andrews and Erie also have issued stock. I don't have to go back and look. I can come down here. I'm sorry. I can look at the cash flow and sales of common stock. So Andrews issued some stock, Digby issued some stock, Erie issued some stock, and Ferris issued some stock. Now, if you take a look at last assignment, you know now, after I gave you the answers, that them issuing stock will have an effect of, 1, reducing their earnings per share, and 2, reducing their ROE. Okay, that said, I'm getting a little bit ahead of myself, but let's take a look. Ferris issued some stock, which kind of surprised me as a computer team, but they raised $6 million, not a big deal. They also issued some debt. They had to pay off a little debt. Okay, they borrowed a lot on the current borrowing, but look at this. they spent $52 million in plant improvements. $52 million. Okay, so maybe that issuance of stock in this case was a part of an overall financing plan. Is relatively small compared to the borrowing, right? They issued 20 million in long-term debt and 30 million in short-term debt. Okay, they still actually have a lot of cash, so I would tell you that they didn't need the 6 million. Okay, but maybe they thought they did or wanted to be safe. Okay, and so they issued the stock, and that might have been a part of their plan to increase those. Now, Digby issued stock and didn't make any plant improvements whatsoever. Okay, and still has $30 million in cash. Erie issued stock and didn't make any plant improvements whatsoever, and has $64 million in cash. Okay, so we've decided, yeah, I'm not going to get cynical. Okay, so we come back up and we've kind of looked over the financial stuff, and we were looking over the stock market stuff and earnings per share. Ooh, look at that. Baldwin jumped up 761, more even than Team Ferris. So impressive. And I think when we were up here, we didn't look at the ROE, and we should have. Again, things that are a result of income, not the cause of. But ROE 20.8% versus Ferris 16.7%. Again, very, very impressive. Okay, very, very impressive. Nice move, okay, by Baldwin there. And we come to the cash flow, and I glance a little bit at this. I see Chester has a ton of depreciation, Ferris a decent amount, other teams a little less so. Okay, what's that a result of? Result of their investments, right, in capital, whether it's capacity, automation, those types of things. Okay, extraordinary gains or write-offs that could come from the sale of capacity and whatnot. Okay. Accounts payable, these I usually glance at just for the sake of it. So when we have positives from inventory, okay, that means that we reduced inventory from the round before. Okay, so every team had positives in inventory, so we sold a lot of inventory. Teams must have adjusted their sales, got rid of a lot of inventory. When I was looking down at the cash things a little bit earlier, okay, geez, did we have big increases in cash? Well, yeah, big increases in cash without necessarily huge profits tell me that we raised cash otherwise. Okay, and that's probably it. Look at that. We sold off 37, 46, 53, 75, 110, 120 million in inventory, all the teams combined. So huge. We'll have to see where the inventories stand. I can look at this and tell you the inventories are going to be way down when we look at it. Okay. Plant improvements, Andrews, Chester, Ferris, all made plant improvements. Interesting. Okay, Baldwin, Digby, Erie chose not to. So we'll see what kind of an effect that has on the game going forward. So issuance of some long-term debt. Well, the two teams that made the biggest investments issued some long-term debt. Okay, and also Ferris also issued some stock. Again, why Andrews, Digby, and Erie? I mean, I'm not gonna sugarcoat that. Why they issued stock? Absolutely no clue. Retirement of current debt. So we pay off current borrowing. Andrews, remember, they've been in a hole, and so apparently they were a little nervous, afraid that maybe they'd have some inventory even though they really sold it off. Okay, so they were in a hole. I'm guessing that they were just being a little safe, a little precaution there, because now they're sitting on 66 million in cash. Look at the cash. Look at the cash buildup. 66, 47, 17, 28, 64, 53 millions. I mean, we're talking millions of dollars in cash. Now, that's a lot of cash. Okay, and is cash king? Cash is king. Cash is wonderful. You can certainly use it to make investments and those types of things. But what's another problem with cash? Well, cash is a part of your total assets, right? Okay, and total assets minus total liabilities equals equity. Okay, so if you have a lot of cash as a part of your total assets, it actually increases your equity. And if you increase your equity, what's that do to your ROE? Okay, again, should we not have any cash? Of course we should have cash. Okay, but managing that cash may start to become an issue. I can tell you that's an issue. When you're sitting at this point in the game with 66 million in cash, okay, that's an issue. You know, it's driving up your total equity, and thus it's driving up, driving down your ROE. Okay, so plant and equipment. Look at the size of Chester. Wow, in terms of its plant and equipment, $175 million. Okay, Ferris 144. But we see Ferris just made a huge investment. Probably show up next round. But total fixed assets. Look at the size there. Yeah. Versus Baldwin is a tiny company, really. Total fixed assets and total assets, right? Huge companies, you know. Digby's even smaller yet. Okay. There's you know, there can be reasons to go small in this game. Okay, going small can create some efficiencies, effectiveness, whatever you want to call it, right? So total equity. Look how small Andrews really is in terms of the total equity. That's kind of interesting. But again, while they have a lot of assets, they're relatively big in terms of total assets. They also still have a lot of debt. Okay, remember they borrowed that $25 million in current debt. They got, you know, a decent amount of long-term debt, more than any other team. Okay. In the income statement, you're going to want to look at the income statement probably to answer one of the questions that I posed for this week. So you should look at the income statement closely for every team, okay, every round. Now, sales and variable costs. Sales, you looked at. Variable costs are a component of contribution margin. I wouldn't look at these dollar amounts. I know I repeat that every week, but I often, you know, ask a question that might regard something like that, and I'll go, well, geez, Ferris had really high variable costs. Well, of course they had really high variable costs because they sold a bunch of stuff. Okay, so it's the total amount's kind of irrelevant. It's in relationship to their sales, which we find through the contribution margin. Okay, depreciation. Ooh, again, we saw Chester had a big plant, right? Big fixed assets, and so they have more depreciation. Ferris likewise. SG&A. Again, Ferris's SG&A to sales ratio wasn't that high, but look how much they're spending. Okay, look how much they're spending. You know, Baldwin's was relatively, you know, what the heck was theirs? Theirs was higher than Chester by far. Yeah, not by far, but by a bit. Okay. But look how, you know, Ferris is relatively low. Okay, middle of the pack to lower middle of the pack. But even though they're spending more, but that's because they're driving a lot of sales, right? EBIT, interest. Okay, again, we saw Andrews has a lot of debt. Ferris a decent amount of debt, but relative to the amount of sales and stuff, yeah, okay. But quite a bit for Andrews, right? They're paying twice as much interest as most other teams, except for Ferris. And then our net profit. Glance at this one, always, okay? And what do I see? I see that we, with the exception of Ferris and Chester, we have so much excess capacity, it's unbelievable. Okay, so much excess capacity. Okay, I don't know if teams forget. You know, I don't know how you could forget when you look right at it. Team Ferris has the ability to produce in the first shift 3,500 units, and it's a little more than that, 36, 37, because they are producing about 7,400 units, so they're producing twice what they have capacity for. Okay, and everybody can do that. Okay, and yet we have Andrews with lots of excess capacity, Baldwin excess, Digby. Look at Erie, you know, 3 times maybe, nearly 3 times the capacity that they need. Wow. Okay, so you've got you know, without getting into details on how it works in the game and whatnot, you got a whole lot of idle capacity. You're paying to heat and turn the lights on and paying for all kinds of stuff, you know, to maintain that capacity that you're not using. So good for you guys. Ooh, Andrews got rid of a product. Interesting. Remember I said up above that we're going to look and we're going to see not much inventory? Look at that. Almost completely out of inventory. The high end has some inventory, and Andrew still has some in their performance. Okay, I remember how much extra they had, and so they're just kind of slowly getting rid of that, but they are getting rid of it. So, okay. And it kind of looks like Andrews is getting rid of that product because they've reduced the capacity down to 100 units. So, looking at this, we look at contribution margins. Baldwin was just nice and steady. All their items, good steady profit, contribution margins. Okay, not a lot of second shift. Chester a little bit more second shift. Remember, they're producing at least a little bit above their capacity. Look at Ferris, 100% of their second shift. Okay, so their total capacity 198%. That's the max that you get to go because 2% they write off or something. Okay. And an important thing, remember we saw up here that both Ferris and Chester invested a lot of money. So I like to look at that, and I like to say, where did Chester invest their money? That's the original capacity, so they didn't increase capacity. Now, Ferris has got capacity all over the place, plus they've introduced one more new product, right? So they've introduced 2 new products. I can tell you that's expensive, so that's part of the $50 million that they've spent, okay? And their capacities have certainly changed in the high performance, okay? And introducing a new product here that's a huge one with huge capacities, unbelievably huge capacities, right? On the other hand, they've gotten rid of some capacity in the traditional and in the low end. Okay, so interesting that would happen. So when I see that a company has spent a lot of money up here in plant improvements, and you got these 2 especially, and I didn't tell you where Chester spent theirs, I'll let you guys figure that out. I'm going to tell you that Chester sacrificed, it appears to me, maybe some profits this round to put themselves in a position to be more profitable in the future, and we'll see. Okay, definitely we'll see. You're going to want to take a look at this. I think one of your questions might involve contribution margin again, and what contributes to or takes away from. Okay, in simple. Okay, to keep it simple, think about this. The contribution margin is 2 things. Sales price is one part of it, okay, and variable cost is the other part of it. Variable costs consist of materials, labors, carrying costs. We're not going to see a lot of carrying costs because we get almost no inventory, right? Okay, so sales price, the higher the sales price, the higher the contribution margin. The lower the sales price, the lower the contribution margin. Variable cost, the higher the material and labor, the lower the contribution margin. The lower the material and labor, the lower the contribution margin. Don't make contribution margin any more confusing than that. Okay, it's not any more confusing than that, so keep it simple. So if I ask you what's causing somebody's contribution margin to be high or low, it's those things: it's sales price and variable costs. Okay, now break it down a little bit. Okay, when I ask you that, if you tell me it's just the variable costs are too low, I'm gonna say, or variable costs are lower. Okay, my question will be which ones, right? Labor, material, carrying costs. Okay, and then look for that and look for the explanation. So, create yourself a little decision tree there, right? Okay, it could be sales or price. Okay, look at the different segments then and tell me, is it higher or lower in certain segments? Okay, the variable cost side, make sure you break it down. Is it material? Is it labor? Is it carrying costs? Boom, 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 and why? Okay, so while it's simple, it can also be broken down. Oh, look at this. So we come down, we take a look at the traditional. And Chester, of course, they got 3 products right up here at the very front end of the traditional market. Does it surprise you that, man, they had a 40% plus potential in that market? Other teams way down here at the 15, 10, looks like 10% or 12% potential. So Chester has jumped out and really, really looks like dominated this market. Okay, it doesn't look like they have. Okay, and it's again because they have 3 products there, especially Cake and Sid. Cake's way back here, Sid's here, okay, and then Coat and Cure, actually 4 products, right? Cake and Sid is 30 or 29, you know, plus 11, so yeah, 40%. Wow. Wow. So that's pretty impressive. Didn't have to spend a lot of money on budget and those types of things. Baker spent a lot. Okay, and Baker's kind of way back here, right? So some interesting dynamics going on there. Looks like these 3 products are pretty well positioned too. You know, as the market moves this way, they're pretty well positioned as it is. So that's interesting. Oh, now this is really fascinating here. Look at Team Ferris. Could have had 35%, 34%, something like that, and only ended up with 15% of the market, so they sold out. It's also important to note up here that in the low end, the total industry demand was 12,500,000 units. You guys in total only made 12,200,000 units, so you didn't meet the full demand. Interesting. Okay, everybody sold out of everything, right? And we had, you know, we got all these low end products. Some of them are leaving. Acres about toast. Okay, but it still sold quite a bit. These ones are all clustered here, and then you got all these ones, okay, that are maybe coming in, maybe not. They're traditional ones that, you know, might be moving backwards, okay. So that's interesting. Chester kind of dominated, other than Ferris. Actually, they dominated sort of in terms of sales, but Baldwin had a lot of sales in this. But man, did Andrews, Baldwin, and Chester, and Erie to a lesser extent, really take advantage of Ferris's inability to meet the potential. Okay, what's that mean? Well, Ferris sold out. Okay, so they just didn't make enough. They could have made twice as many. Okay, and your question might be on the assignment is, why did Ferris have such great potential? Okay, just look these things over. Okay, when I ask you that too about why a team has a potential in a certain segment, customer buying criteria. Okay, customer buying criteria as it relates to, you know, the stuff that's down here, right? Number 1's price, number 2's age, number 3's ideal position. Okay, so should we look at those things in that order maybe and determine if, you know, was price a big factor? Yeah, maybe, maybe not. Was age a big factor? Maybe, maybe not. You should look at those things. Okay, high end. Look at that. Ferris not only had the biggest sales by far, more than all the other teams put together, but also had a potential to completely dominate. You can just look at the perceptual map and see nobody's competing with them. Literally nobody is competing with Ferris in the high end. Okay. And remember, I told you that after about the 3rd round, we probably get a pretty good fix on where teams are positioning themselves. Okay, and that's without question. We can tell where teams are positioning themselves, or at least one team, right, compared to the other team. So high end, look at that. Fist and Fox, you know, 55% right there. Looks like Dixie and Bid in there, Echo's in there someplace. Can't see Echo on this one, but probably on the bigger one. But you know, so cleaning up, getting a few sales here and there, but not a bunch. Okay, and we're going to see similar things here in the performance side. Looks like Bold is maybe trying to keep pace, but Ferris again way out in front. Okay, and even more stark here in the size. Okay, again, you see some of these that got the benefit of a few sales, but you know, nobody's competing against Ferris. Okay, so what's that tell you? Okay, well, when we look at the larger map, we'll see. I didn't really ask any questions about potential versus actual again, but interesting to see. This is, well, let's look at the big perceptual map. Okay, and it gives us a little better idea. Was it Echo that sold quite a few in this one? Egg, I'm sorry. So it was Erie's egg product, but we can tell. Okay, you can tell by golly what Ferris's competitive position is, what their strategy is. Okay, that shouldn't be a secret. Okay, you can also tell that the student-run teams are not adopting that strategy. Now, this is the point where I tell you that tactics, and as we talked about earlier, that when you've surveyed the marketplace, and you guys should be doing a really major survey of the marketplace, that there may be some tactical opportunities available. Okay, let me rephrase that. There are some tactical opportunities available if you're put yourself in a position to take advantage of those. Okay, might involve a little bit of math, and might involve a few other things. Okay, and analyzing what's available and taking advantage of it. Okay, HR. Interestingly, we see Ferris is the only team now has made sufficient enough investment. I take that back. Chester to a little lesser degree, but they're actually starting to see some productivity that's measurable, 2.3%. Well, now that doesn't sound like a lot, but remember when your labor bill is 50 million, which it easily is for Ferris, 50 or 60 million. 2% savings on that is $1 million. $1 million per year, and that's going to go on forever. Okay, that's going to go on for the rest of our rounds. So I don't know what Ferris's overall investment in this was for these past rounds, but now if we were in the competitive rounds playing 8 rounds, they'd still have 5 rounds left, and they'd save $1 million, more than $1 million, because their labor no doubt is going to go up each year, as they produce more. So they're going to save $1 million plus every year after that. So something you might want to take a look at. Okay, TQM, no investments in that, but that's coming up next round. Okay, TQM is coming up next round, so please watch the tutorial. Take a look at that. Investments in TQM are directly affect profit in that year. Okay, it's an expense. It's not like investing in equipment that becomes a depreciable asset. That is a depreciable asset. It's a direct expense, but like the investment in the HR, its benefits also last for years to come. So something to consider there. All right, let's take a look at this week's assignment. Why did Chester's contribution margin fall so much? Take a look at that. You're probably going to go back and look at last year's contribution margin and see where it was, and then see what it came down to. But it's down to what, 27% I think this year, and I think last year it was over 30. Okay, it might be less than 27%. Let's bounce way up here and take a look. Oh, 23%. Yeah. And I think last year was around 30. You go back and look at round 2, and you can look at the prior rounds. Okay, so go back and look at round 2 and see what that tells you, and then try to let me know why it came down so much. Okay, question 2: Why did Ferris have such a large potential in the low end segment? Okay, again, go look. I said customer buying criteria, right? Go take a look at that customer buying criteria and compared to what Ferris did. Okay, 3. Andrews had about 6.8 million in EBIT, or earnings before interest and taxes, but overall suffered a loss of about 2.5 million. What was the cause? All right, so what caused them to lose money? Okay, even though they had a positive earnings before interest and taxes. That ought to give it away a little bit right there. Okay, but take a look. That's where you're going to look at the income statement. Okay, and you'll see where the 6.8 million in EBIT shows up. Look at the stuff below that. Okay, it might give you the answer. Number 4, Baldwin's sales were 90 million less than Ferris, yet it ended up with more profit. Why? And I gave you some of those answers. Okay, some. Once again, this is going to be a multi-part answer. So the answers that I kind of gave you, go take a look at that. But then you also going to look at the income statement for this one. Okay, because there may be another answer or 2 in that income statement. Okay, this is one of those questions where please don't say the variable costs were less. Okay, because obviously they were, because they had a lot lesser sales. Now, if you say proportionately, that would make sense, but alternatively, and what they give us is the contribution margin. So do that. Okay, So there's your assignment for round 3. We can go take a look now. I input the numbers, and I think they got in there. Let's see who won it. I haven't seen yet either because I didn't do it yet until we got this all done. I better save that. Okay, round 3P. Practice round 3. Let's cruise on down here and see what we got. Ooh, okay, so Baldwin, earnings per share, the highest. So a student-run team beat the computer team. ROE, Baldwin, the highest. Impressive. Contribution margin, Andrews actually had the highest contribution margin. Good job, Andrews. You know, nice comeback. Andrews had dug themselves a bit of a hole, and they've actually made a nice comeback. Even though they didn't make a profit this year, they've kind of worked themselves back into a reasonable position. Stock price, Baldwin had a huge increase in its stock price, not surprising. Ferris following on that, and then Erie and Andrews. Chester not so much. Profits, Team Baldwin, so had the biggest profits there. Again, it wasn't a huge amount, but it was impressive again given that their sales level is so much lower. Cash flow, Team Andrews benefited the cash flow, so good job there. Strategy, no difference. So look at that, Baldwin, almost a clean sweep. You know, they took a little hit for contribution margin, a little hit for cash flow, but otherwise they scored the highest in all of them. Now, do they have any discounts for working capital leverage or emergency loan? We know they didn't have an emergency loan. No discount for leverage, although Andrews did, interestingly, and no other for working capital. So their score stays the same. So congratulations to Team Baldwin. Good job. You know, on again, you know, middle of the road sales, but taking advantage of some of the other opportunities. Now, if I were looking forward, though, I'd be taking a look at what the other teams have done to prepare themselves for future rounds, because there's some stuff in the works, and I'm excited to see it happen. That said, I'm going to sign off for today, and everybody have a good week, and remember, round 4 decisions are due Sunday night. Thanks.